say you want to buy Apple on the hope that a new iPhone will drive the stock higher. Problem, one share around 200 bucks. Solution, options. Because using them, you can get long Apple for less than $1. How's that? You can buy one call that's close to where the stock is trading, but that's expensive, and in order to make money, you need Apple to rise by more than the cost of that call. So to cut that cost and increase your odds of success, you can then sell one out-of-the-money call of the same expiration and create a call spread. Now you've reduced your cost, but you've also capped your profit. That's now limited to the difference between the strike of the call that you bought and the strike of the call that you sold. But you still need Apple to rise more than the cost of that call spread to make money. So to spend even less on the spread, you need to collect more money. One way to do that, selling an out-of-the-money put of the same expiration. Now you've spent next to nothing, but there's a trade-off here too. By selling that put, you're now obligated to buy Apple stock should it fall below that put strike price by expiration. So let's recap. Between the money you collected selling one put and the money you collected selling one call, you were able to buy that one at-the-money call for next to nothing. And that's no hype, Steve. So what do you need to know to get started?
Okay, we should note this strategy is a little bit tricky, but the payout could be huge. So let's get to work, open up that playbook, and break it down for you. Let's first address the call spread part of this trade. Mike, what do you look at?
Well, I think there are two things that you want to remind yourself about when you're going to trade a call spread. One is that part of the purpose is so that you can get a strike that's a little bit closer to at the money. The other thing is that it helps mitigate a decrease in implied volatility, which is something that Scott was talking about earlier. After a catalyst, sometimes you can see that. So you usually are looking to get perhaps a slightly lower strike to the call you buy. Obviously, when it comes to the one that you sell, don't sell the ones that are trading at a teeny, as we say. You don't want to sit out there and try to pick up nickels in front of an oncoming train. Make sure that the call you sell has enough premium to really make it worthwhile.
All right, let's talk about that put strike, Dan.
Sure, and the put strike is very simple, but actually a lot more important about choosing, because this is where you can really get tripped up. You got to sell at a level where you're prepared to get long, and that's just that simple. Because if the thing starts going that way, the implied vol is going to shoot up in that option, and you're short that option, and you will get hurt mark to market in between then and expiration.
And the tricky thing to think about is that if it goes through that put strike, there might be a reason, a good reason,
sure,
why it's heading lower.
Yep.
All right, Scott, time frame.
Time frame. This generally works with a catalyst. This kind of a trade can work with a catalyst because a whole lot of volatility is not going to come out of this trade. If it does, then you're not really going to get hurt because you're long and short. So this works well for a catalyst as opposed to, say, a trending type of trade where you might think, hey, the stock's just going to go higher, and I'll put it on for that reason.
All right, Dan, you've been the Apple savant here on the desk. So when we talk about a 4G iPhone, is this really going to be something big?
Well, here's the thing. None of us know, and we never